America's national debt has reached $38 trillion, not a future projection, not next year's estimate, but the actual debt recorded on the books as of December 2025. If you think this number doesn't affect you personally, it's important to pay close attention. While most people have been busy scrolling through social media or watching Netflix, the world's largest financial institutions have quietly begun doing something they haven't done in over 75 years, systematically moving massive amounts of money out of dollar-denominated assets. This shift isn't driven by conspiracy theories or rumors. It's backed by documented capital flows, public filings, treasury data, and verifiable numbers. By the end of this discussion, you'll understand what's happening, why it's happening, and most importantly, what may come next. There is a clear pattern at play, a mathematical pattern that has repeated itself 3 times over the last 500 years, following the same stages, the same warning signs, and ending with the same devastating outcome. We are watching that pattern unfold again right now, in real time, and the only question is whether you will recognize it or end up like millions before you, wondering how you missed all the signs. Stay with me, because the next 15 minutes could permanently change how you think about money. Global debt has now reached $251 trillion according to the IMF's latest data, representing 235% of global GDP, the highest ratio ever recorded in peacetime history. U.S. debt alone surged from $36.1 trillion in January 2025 to $38.4 trillion by December, a $2.3 trillion increase in just 11 months. But what few are talking about is that this exact scenario has happened before, 3 times in modern history, and every single time, the nation holding the world's reserve currency collapsed within 36 months of smart money exiting. These were not similar events, but identical patterns, with the same stages, the same timeline, and the same result. This pattern is mathematical, predictable, and once it reaches a certain point, unfortunately unstoppable, and now I'll show you how it works. Every major economic collapse over the past 5 centuries has followed a precise 4-stage cycle. The first is the ascension phase. When a nation becomes the center of global finance, capital floods in, its currency turns into the standard for international trade, banks expand, markets boom, innovation accelerates, and confidence feels absolute, a phase that typically lasts 50 to 80 years. The second stage is overextension, where success breeds arrogance and governments begin spending far beyond their means through military expansion, foreign interventions, and domestic programs, all funded by debt that grows faster than the economy. Asset prices keep rising, real estate and stock markets hit records, central banks print money to sustain the illusion of prosperity, and this stage lasts 20 to 40 years. The third stage is the silent exodus, the most critical phase, when smart money, not the public or politicians, but those who read balance sheets, quietly begins rotating capital out through calculated, systematic moves into safer jurisdictions. Foreign investors reduce exposure, wealthy families diversify internationally, and what starts slowly accelerates over 18 to 36 months. The final stage is collapse, when the currency loses reserve status. Foreign central banks dump their holdings, inflation surges, interest rates spike, asset prices crash simultaneously, banks fail, pensions evaporate, the middle class is wiped out, political chaos erupts, and everyone asks the same question: how did we not see this coming? The answer is simple. The pattern was always there. And now it can be proven through 3 historical examples, 3 global superpowers, 3 reserve currencies, all following the exact same cycle with the exact same outcome, beginning in the 1500s with Spain, the most powerful empire on earth, without debate or competition. Spanish galleons returned from the Americas carrying more gold and silver than the world had ever seen, establishing the Spanish real as the global reserve currency and turning Madrid into the financial center of the known world. Stage 1 complete. King Philip II controlled half of Europe, Spanish armies were considered unstoppable, the Armada ruled the seas, and wealth poured in from colonies across 3 continents. But that wealth was spent recklessly. Endless wars with France, England, the Ottoman Empire, and the Dutch, a massive military presence across 3 continents, an enormous bureaucracy that consumed fortunes, royal palaces that cost kingdoms, and the Spanish Inquisition burning money along with heretics. By 1550, government spending had reached 300% of revenue, 3 times what Spain collected in taxes, with the gap filled by borrowing from Italian banks, German merchants, and anyone willing to lend. As long as gold kept flowing from the New World, no one worried. Asset prices continued to rise, everyone felt wealthy, and the empire seemed invincible, confirming stage 2. Then quietly, the shift began. By 1555, major Spanish banking families started moving assets to Genoa, and the Fugger family, Spain's largest creditors, began demanding repayment in gold instead of promises. They wanted out. By 1556, wealthy merchants began transferring their operations to Amsterdam, not all at once, but gradually, opening offices, moving inventory, and redirecting trade routes. They did this because they could read financial statements, and those statements showed that Spain was functionally bankrupt. The Spanish government was paying interest rates as high as 40% on some loans, a clear sign not of strength but of desperation written directly into official documents. Stage 3 was now undeniable. In 1557, Spain defaulted on its debts for the first time, freezing credit markets and rendering Spanish bonds worthless overnight, while the government seized private gold shipments just to pay its soldiers. Chaos rippled through the financial system, yet the king insisted it was temporary, a one-time problem, and that everything would be fine. It wasn't. Spain defaulted again in 1560, again in 1575, again in 1596, and again in 1597, 4 defaults in just 40 years. The currency collapsed, inflation destroyed the middle class, Spanish power evaporated like morning fog, and by 1600, the once invincible empire was reduced to a shadow of its former self, its golden age gone forever. It never came back, stage 4 complete. So where did the money go? North, to the Dutch Republic, where Amsterdam became the new center of global finance and ushers in the second example. By the 1600s, Amsterdam was the richest city in the world by every measure. The Dutch East India Company alone would be worth an estimated $828 trillion in today's money, more than Apple, Microsoft, Amazon, and Google combined, twice over. Dutch banks financed global trade, the Amsterdam Stock Exchange became the first in history, and the guilder emerged as the world's reserve currency, making international business impossible without it. Capital poured into Amsterdam from Asia, Africa, the Americas, and across Europe, as global money-seeking returns flowed into Dutch banks. The Dutch Republic of the 1600s was effectively Silicon Valley, Wall Street, and London combined into a single square mile. And for those wondering where these numbers come from, every figure is drawn from official, verifiable sources, Treasury data, IMF records, and congressional reports, all publicly available to check. Stage 1 was undeniable. Then came the wars, because they always do, beginning with 3 Anglo-Dutch wars between 1652 and 1674. The wars expanded, conflicts with France, with Spain, and a Dutch military presence stretching from Indonesia to Brazil to South Africa, and all of it required enormous sums of money. Government debt exploded from 4 million guilders in 1650 to 80 million by 1690, a 20-fold increase in just 40 years, financed largely through money printing, a pattern that should sound familiar. At the same time, tulip mania took hold, with bulbs selling for more than houses and rare specimens costing up to 10 times an artisan's annual income, as asset prices detached completely from economic reality, and everyone felt wealthy on paper. Behind the scenes, the Bank of Amsterdam, considered the safest financial institution in Europe, was secretly lending depositor funds to finance government wars, effectively running fractional reserve banking before it even had a name, a Ponzi scheme cloaked in legitimacy. Stage 2 was complete. By 1690, the smart money began to move. Major banking families shifted operations to London. Sephardic Jewish merchants who had helped build Amsterdam's wealth started relocating. Portuguese traders opened offices in England, and German financiers systematically withdrew capital over several years. They did this because insiders knew what the public did not. The Bank of Amsterdam was broke and had been since 1672, using new deposits to cover old withdrawals for decades. Classic Ponzi mechanics. But the secret held only until it couldn't anymore. Stage 3 was fully verified. In 1795, French revolutionary armies invaded, the Dutch Republic collapsed, the guilder failed, and the Bank of Amsterdam's fraud was exposed, wiping out depositors and igniting riots, political chaos, and the abrupt end of the Dutch Golden Age. 150 years of dominance vanished in a matter of months. Stage 4 complete. So where did the capital go next? To London, as Britain became the next link in the cycle. This third example matters most because it is the most recent and the closest parallel to today, spanning the 1700s through the 1900s. At its height, the British Empire was unrivaled. The sun never set on its flag. It controlled 23% of the world's population and nearly a quarter of Earth's landmass. And the pound sterling served as the global reserve currency for more than 200 years, longer than any currency in modern history. London became the center of global finance, the place every nation went for capital, as British banks funded American railroads, African mines, Asian plantations, and infrastructure across every continent. More than 60% of international trade settled in pounds, the gold standard revolved around sterling, and British dominance appeared eternal, stage one in its purest form. Then came the 20th century and the shock of two world wars, beginning with World War I, which alone cost Britain $44 billion, equivalent to over $600 billion today. They borrowed relentlessly from America, from their own citizens, from anyone willing to lend, as government debt surged from 30% of GDP to 130%, a number worth remembering because it's the same level the United States sits at today. Britain tried to remain on the gold standard and failed in 1931, briefly returned, and failed again in 1933, signaling that the system itself was breaking. World War II only deepened the damage with more debt, more money printing, and more promises that couldn't be kept, leaving Britain technically victorious but financially ruined and dependent on American loans just to survive, stage two confirmed. By 1949, the quiet exodus began as major British corporations like Unilever, Shell, and British Petroleum didn't abandon Britain outright, but gradually redirected investment and capital toward America. Wealthy families moved assets overseas to Switzerland, the US, and Canada, fleeing an overtaxed, overregulated, and declining economy, while a massive brain drain followed as scientists, engineers, entrepreneurs, and academics left for American opportunity. By 1960, foreign investment in Britain had fallen 62% from pre-war levels. The money was leaving, the talent was leaving, and so was the future. Stage 3 complete. Then came 1967, when the pound was devalued 14.3% overnight, a forced decision after Britain ran out of foreign currency reserves defending its exchange rate. The final blow arrived in 1976 when Britain turned to the IMF for a bailout, a humiliating moment that marked the end of its global financial dominance as the pound lost reserve currency status and international trade shifted decisively to the dollar. Stage 4 was verified. 3 empires, 3 reserve currencies spanning 500 years, Spain, the Dutch Republic, and Britain, all followed the same 4-stage path from dominance to collapse, and now the question becomes unavoidable. Why is America showing the clear signs of being in stage 3 today, beginning with 1944 at Bretton Woods when the dollar became the world's global reserve currency? The dollar was initially backed by gold at $35 per ounce, and other currencies were pegged to the dollar, creating a system that positioned America as the global financial leader. Emerging victorious from World War II while Europe and Asia lay in ruins, the U.S. became the world's magnet for capital. American markets, stocks, bonds, real estate, treasury, securities, became the deepest and most liquid on earth, sparking a golden age of dominance that lasted from 1945 to 1971, a full 26 years, stage 1 complete. Then came August 15, 1971, when Richard Nixon ended gold convertibility, turning the dollar into pure fiat currency, backed by nothing but trust in the U.S. government. With all limits removed, spending exploded. U.S. national debt climbed from $900 billion in 1980 to $3 trillion in 1990, $5.6 trillion in 2000, $10 trillion in 2008, $27 trillion in 2020, $36.1 trillion in January 2025, and $38.4 trillion by December 2025, a 4,200% increase in 45 years, more than doubling in just 5. But government debt is only part of the picture. Corporate debt reached $13.5 trillion, household debt $18 trillion, student loans $1.77 trillion, credit card debt $1.1 trillion, auto loans $1.6 trillion, and medical debt hundreds of billions, bringing total U.S. debt to over $100 trillion or 370% of GDP. For perspective, Spain defaulted at 200%, the Dutch Republic collapsed at 250%, Britain lost reserve status at 130%, and America now sits at 370%, surpassing every historical precedent. And it's still climbing. How do we pay the interest? The U.S. government now spends over $1 trillion per year just on interest payments, more than defense, more than Medicare, more than most entire federal agencies combined. That's interest alone, not paying down any debt. To fund it, the government prints money. The M2 money supply surged from $15.5 trillion in February 2020 to $21 trillion by April 2022, a 40% increase in just 26 months, the largest monetary expansion in American history. The result? Inflation, asset bubbles, and growing wealth inequality, the textbook signs of stage 2. Stock markets sit at all-time highs while real wages stagnate. Price-to-earnings ratios reach bubble levels, and housing prices have soared 73% since 2019. Every asset class is inflated. The Federal Reserve's balance sheet exploded from $800 billion in 2008 to $9 trillion in 2022, buying treasuries, mortgage-backed securities, and corporate bonds, artificially propping up prices. Stage 2, complete, verified, mathematical. Now comes Stage 3, the exodus. China, which held over $1 trillion in U.S. treasuries in 2013, has sold more than $300 billion over the last decade, reducing its holdings to $760 billion. Japan, the largest foreign holder, has quietly sold $220 billion since 2022, month by month. Saudi Arabia is selling, Belgium is selling, Switzerland is selling, France is reducing exposure, and even the Federal Reserve is shrinking its balance sheet through quantitative tightening. The smart money is moving. They're letting bonds mature without reinvesting, draining liquidity from the system. So who is buying U.S. debt now? Mostly the government itself, the Federal Reserve, government pension funds, engaging in circular financing, printing money to buy their own debt. That is not strength, it is desperation. And it's not just governments taking action. Major financial institutions are restructuring. BlackRock, the world's largest asset manager with over $10 trillion in assets, has reduced U.S. Treasury exposure and increased holdings in emerging markets, European infrastructure, Asian real estate, gold, and commodities, diversifying away from concentrated dollar risk. J.P. Morgan has restructured institutional allocations. Goldman Sachs reduced U.S. equity recommendations. Morgan Stanley increased international allocations. And Bridgewater Associates has long warned of dollar devaluation and positioned accordingly. The smart money is moving, just like it did in Spain, Amsterdam, and London. Stage 3, verified. Stage 4, history tells us, is inevitable. The dollar gradually loses reserve currency status, not overnight, but slowly, until suddenly countries start settling trade in other currencies. It's already underway. China and Brazil are trading in yuan, bypassing the dollar entirely. India and Russia are increasingly settling trade in rupees, while BRICS nations are developing alternative payment systems. Today, over 40% of global GDP is in BRICS-aligned countries building infrastructure to trade without relying on dollars. A critical point, in June 2024, headlines claimed the petrodollar agreement had ended. In reality, the 1974 U.S.-Saudi Joint Commission on Economic Cooperation simply expired. There was never a formal written agreement requiring Saudi Arabia to price oil exclusively in dollars. Still, Saudi Arabia has recently expressed willingness to accept other currencies for oil, including yuan-denominated transactions. The practical effect is clear. The dollar's exclusive grip on oil markets is loosening, fracturing the petrodollar system more slowly than sensational headlines suggested. When global dollar demand drops significantly, foreign-held dollars flow back into the U.S. economy, sending inflation vertical. The Federal Reserve will face an impossible choice: raise interest rates drastically to crush inflation, making the $38 trillion debt unpayable and crashing the economy, or keep printing money, triggering hyperinflation. Either path ends the same way. Asset prices collapse as liquidity vanishes. Stocks, bonds, real estate all deflate simultaneously. Banks fail, pension funds go insolvent, insurance companies collapse, and the middle class, holding most of its wealth in dollars and dollar-denominated assets, is wiped out. Savings evaporate, retirement accounts vanish, and home equity disappears. This isn't speculation, it's the pattern, and it has happened every single time. History shows that military might, advanced technology, or innovation cannot stop it. Spain had the most powerful military in the 1500s, and the Dutch had the most advanced financial systems in the 1600s. Neither could prevent collapse. India and Russia are increasingly settling trade in rupees and rubles, and BRICS nations are actively building alternative payment systems to reduce reliance on the US dollar. Moves confirmed by special rupee settlement accounts and expanded local currency trade between India and Russia. Over 40% of global GDP now lies within BRICS and aligned economies, many of which are developing infrastructure and financial rails that bypass the dollar. In June 2024, widely reported stories claimed the petrodollar system had expired. While the original 1970s U.S.-Saudi understanding simply expired, Saudi Arabia and others have shown willingness to accept other currencies, such as the Chinese yuan in oil trade, which loosens the dollar's exclusive grip on energy markets. As countries diversify reserves and trade settlement away from dollars, the practical effect is similar to a fracturing petrodollar regime. When global demand for dollars drops, foreign-held dollars can repatriate into the U.S. economy, potentially driving inflation sharply higher. This puts the Federal Reserve in a bind. Sharply raise rates to tame inflation, which can make the $38 trillion U.S. debt untenable and crash the economy, or continue printing money, risking currency debasement and hyperinflation. In either case, the historical pattern suggests a potential cascade where asset prices fall, banks strain, pensions and insurance funds falter, and the middle class, largely invested in dollar assets, suffers acute losses. History shows that military strength, advanced technology, or innovation cannot prevent economic mathematics from playing out. Like Spain, the Dutch Republic, and Britain before it, confidence in a currency can erode under unsustainable debt and systemic shifts in global finance. Patterns now echoed in de-dollarization trends and reserve diversification. Diversification is no longer optional, it's survival. Focus on assets that preserve value during currency debasement. Gold, which has maintained purchasing power for 5,000 years, silver, commodities, and real assets that cannot be created out of thin air by central banks. Geographic diversification is also critical. If major institutions are moving capital internationally, consider following suit with part of your portfolio. Research stable foreign currencies such as Swiss francs, Singapore dollars, or Norwegian kroner to spread political and economic risk across jurisdictions. Understand the timeline. Stage 3 historically lasts 18 to 36 months, and we are likely 12 to 15 months in, meaning you have months, not years, to act strategically. Increase liquidity. Keep accessible cash, which, while eroded by inflation, provides the flexibility to seize opportunities when asset prices crash. Illiquid assets trap you when mobility is most crucial. Finally, reduce debt. Holding high leverage in a rising rate environment is financial suicide. These steps are not theory. They are grounded in patterns observed repeatedly across centuries of global financial history. If you're leveraged, act now. Every point that interest rates rise makes debt more expensive to service, and rates are structurally headed higher. Sixth, invest in skills and relationships. Human capital is the one asset that survives every collapse. Skills that create value, knowledge that solves problems, and relationships built on trust cannot be inflated away or confiscated by governments. Seventh, stay informed. Those who navigate these transitions successfully are the ones who recognize the pattern early and don't wait for mainstream media to confirm what the data already shows. Subscribe and stay engaged because the next breakdown will show which assets historically preserved wealth during Stage 4 collapses and which were destroyed: gold in Britain, real estate in Spain, stocks across every major currency crisis. The pattern repeats, the cycle continues, and understanding it allows you to position yourself correctly. This is not fear-mongering. It's pattern recognition, 500 years of economic history showing the same cycle again and again. America's debt hit $38 trillion for a reason. Foreign central banks are selling for a reason. Major institutions are diversifying for a reason. They see the same pattern you just learned, the same pattern that destroyed Spain, the Dutch Republic, and Britain. We are now in Stage 3, the capital flight phase, the silent exodus. The smart money is leaving, and the warning signs are everywhere if you know where to look. Stage 4 is coming, and the mathematics are inevitable. The only question is whether you will be positioned correctly when it hits, or whether, like millions throughout history, you'll ask how you didn't see it coming when all the signs were right in front of you. The information is here, the pattern is clear, and the data is verifiable. The choice is yours. Drop a comment below to share your thoughts, preparations, disagreements, or questions. I read every single comment. Subscribe, because the next video will reveal 3 specific sectors that historically outperform during currency crises, sectors that could protect your wealth or even position you to profit from what's coming. The pattern doesn't care if you believe in it, accept it, or have faith in it. It unfolds every time, like clockwork. And remember, the people who survive these transitions aren't always those with the most money. They are the ones with the best information and the courage to act on it.